Is going to be hopefully an insightful and informative as well as educative session. The aim of this webinar is to enable you to sort of just start thinking about the things you should start preparing for when it comes to IFRS 17. I'm pleased to announce that we have put together, a number of professionals as well as our regulators to please, share their insights as well as sort of give tips on how to prepare and get ready for IFRS 17. As we all know, IFRS 17 is the standard on insurance contracts that's going to change the reporting as well as business of insurance companies and those who issue insurance contracts all around the world, all entities that issue insurance contracts. Before I hand over to our the head of our financial services, Sam Abu, to give his opening remarks, I would just like to talk about a few features on this particular platform, WebEx, for those who have not used WebEx before. In addition to that, I would also like to inform you that this session is being recorded. So after this session, if you'd like to get a copy of the session, we can also make that available. So WebEx is a platform. Currently, there you will not be able to, as attendees, you will not be able to unmute yourself. However, if you would like to you would like us to unmute you, you will find a hand button on the bottom right of your screen. There's a Q&A button. You see a Q&A sign. Above the Q&A sign, there is a hand button. If you click on that hand, it will notify the host that you would like to be unmuted. That's in case you want to ask a question or you have a query, and then we can unmute you. In addition to that, we want to encourage everyone to please make use of the Q&A section of the chat. So during the session, we're going to be going through an overview of IFRS 17. We're going to be looking at things to expect. We're going to look at implementation challenges and looking at a few tools to bear in mind. But as the time goes on, if you do have questions, you can click on the Q&A button on the bottom right, and this will enable you. You can type in your questions there. We'll then be able to field your questions to the panelists as well. Even though at the end we will also have a Q&A button, but we'd like everyone to type their Q&A, their questions in that Q&A section as well. So hopefully that is quite clear. If you have any other issues, please just type in the chat. There's also a chat function on the right. You will see it, a bubble chat. You can also click on that and you can put in anything there that you have any concerns about. Okay, so without further ado, I would like to hand over to Sam Abu, who is our financial services leader. Evans, can you move to the next slide, please? I can't seem to move the slide. Okay. Next slide, please, Evans. Thank you. Okay, Sam, over to you.
Okay. Thank you very much, Bolale, and I do hope everyone can hear me. Good morning, ladies and gentlemen. My name is Sam Abu, and I want to welcome you to this session, this very important session. And I want to thank you for taking the time out of your busy schedules to join us today. This 2020 has been a particularly challenging year for everyone, and I'm sure for many of you on this webinar, you have attended countless webinars, countless online meetings, and probably many of us are suffering from online fatigue or webinar fatigue. But I promise you this is going to be a very insightful and valuable session, and I encourage everyone to participate fully in this session. IFRS 17 is effective in 2023 January. That is 2 years from today. It is an extremely complex standard, and 2 years is not nearly enough time to get everything that needs to be done. So there's not enough. There's a lot to be done in the time, and I think the time to start is now. As Bolanle has mentioned, it completely revolutionizes the way you report financial and even the business of insurers in terms of how revenue is recognized, how profit is determined. So clearly, there's a lot of engagement and education that is required for all stakeholders, from your employees to the board, to investors, to analysts, and to other stakeholders in your financial reporting value chain. And this is the time to start having those conversations. There are significant implications for insurers from the decision point around your systems, your current systems, your IT infrastructure. Are they adequate for IFRS 17? Do you need to buy new systems? Do you need to upgrade existing systems? All of these decisions come with significant cost implications, and you need to start the conversations around what you want to do right away. There are decisions to be made around policies and procedures. You have to review contracts to determine whether there are onerous terms and conditions that could potentially have a negative impact on your profitability. And what will you be doing around this contract? What would you be doing around agreements that you're already in from the perspective of IFRS 17? Clearly, there are also significant data requirements, data needs, data sensitive, as you'll be hearing in this call, both from a historical perspective and futuristic. Do you have the mechanisms? What are the mechanisms for gathering the data that you require to implement IFRS 17? And efficiently and effectively collecting data for reporting in an IFRS 17 world. These are some of the challenges that you would face as reporters in an IFRS 17 environment. And, the good news is there is help available. In PwC, we have been supporting a number of reporters across the world in implementing IFRS 17 and getting them ready for IFRS 17. On this webinar, many of the people you'll be talking to today have very deep knowledge and they're experts in IFRS 17 from both a theoretical perspective in terms of how well you understand the standard and a practical hands-on perspective because they have been involved in helping people implement the standard. We also have the regulator here who can give us a flavor around what it means from a regulatory perspective. So I do hope and ask you to engage in the process fully, to ask questions and ensure that all your questions are answered, and subsequent to now to engage us to make sure that you are satisfied with how the journey you're taking. To close, there is a famous Chinese proverb that says the best time to plant a tree was 20 years ago. The second best time is today. And I think using that analogy, the best time to start the preparation for IFRS 17 was 3 years ago. The second best time is today, this morning. On that note, I want to say thank you for joining us again, and I do hope you have a good time. Bolanle.
Thank you very much, Sam. I just realized that I didn't introduce myself. My name is Bolanle Adekoya. I'm a partner in PwC, and I head the capital markets accounting advisory services in PwC, and I cover the West Market area. So apologies for that, for not introducing myself, and I'll be your host for today. Thank you once again, Sam, for your opening remarks. I would like to hand over now to our regulators in NICOM, and I'm very, very pleased to have our Director of Inspectorate, Mr. Barry Thompson, who has vast number of experience, especially, having been in industry in the past and also now as our regulator, to give his remarks on IFRS 17 and what the expectations are from a regulatory point of view as well. So good morning, Mr. Thompson. We're extremely pleased that you've been able to join us today, and we would like to hear from you, sir. Thank you, sir.
Yeah. Good morning, Bolanle. Good morning, the entire team from the PwC family of firm. Good morning, participants from Nigeria, from around the globe. For and on behalf of the Honorable Commissioner for Insurance, the entire management team and staff of NICOM, I extend the Commission's greetings to the firm and all participants in this webinar on IFRS 17 adoption. We've been given to speak on regulatory perspective and expectations in relation to IFRS 17 adoption. Ordinarily, we just should give just the remarks to usher in and to start the program. Nevertheless, we'll still throw a light on a few issues and a few things that will also assist in subsequent discussion that we go on through the period of this seminar. Now, the program objective is very clear. It is to re-sensitize insurers as well as driving conversations around the IFRS 17 implementation challenges that entities may be experiencing at this time. Of course, like I mentioned, the theme given to us is regulatory perspective and expectations. You all are aware that NICOM, being a government establishment, will use IFRS for its accounting standards and preparation of its financial statements. And so one can comfortably, from the perspective of NICOM here, conclude that IFRS is not NICOM. And secondly, that being the regulator of the insurance industry, of course, we share in all that concerns the insurance industry on IFRS 17. I want us to also recall that the responsibility over financial reporting is not necessarily that of NICOM. It situates with the Financial Reporting Council of Nigeria. We should all get that in mind. And so whatsoever is expected of NICOM or NICOM has done so far, has been doing or will do, is only in support of FRC or FRCN's effort, and also efforts to ensure that financial reporting coming out of the insurance industry are in conformity with best practice standards around the world, particularly with the inception of IFRS 17. Now, talking about the regulatory perspective, two perspectives will quickly come to mind, and just as is done around the world. The regulator could choose one of two things. It could choose to allow insurers to adopt individual roadmaps, implement the standard, and file IFRS compliance returns by 2024, or say from 2023. That's one perspective, and that is one option for us in regulation, and which also some jurisdictions have practiced. The second option is that we, the regulator, will coordinate, issue industry roadmap, issue guidelines, monitor and review progress of implementation of standards up to and even after the implementation in the adoption in 2023. And so we have two of these options before us. However, because of the support and our responsibility and our environment, we have chosen the second option. That is, to support the industry, to put advisors together, to coordinate, issue roadmap, guidelines and monitor and review progress of implementation of the standards. That we have chosen that route to go. Expectations. We would request, receive, and review regular returns of insurance during the transition period, monitor compliance with roadmap activities, and then carry out sensitization of stakeholders of the regulatory body, not necessarily of the industry. That of the industry will be at the high level point. However, I need to just enlarge the scope of what I have said by saying that there are 4 clear areas or thematic points that we will work along with. One is sensitization and coordination. The other will be issuance of regulatory roadmap and guidance notes, as I've just mentioned. And then review and monitor implementation by the industry. And then, as far as possible, issue harmonization directives. Those are some of the things we have planned to do. Now, under sensitization stroke coordination, we'll carry out high-level sensitization and coordination of insurers and reinsurers. This sensitization we were supposed to have done early in the year. We have done it before the end of April this year, but for the COVID lockdown, which stopped all of this action. Recall also that on 28th of January 2020, the Commission issued the roadmap, released the roadmap to the market, which I want to believe, despite the lockdown, the companies, insurers and reinsurers have been taking steps to gradually observe and comply with all that was required in the roadmap. Now, that roadmap between then and now, it happened subsequently that the IFB extended the compliance date and to 1st January 2023, and so it has become imperative that that roadmap will be reviewed. Still talking about sensitization, we also sensitize NICOM's stakeholders, both internal and external. We have the National Assembly, we have our own staff. We also have the core training for our financial analysis staff as well. Now, talking about the roadmap and guidance note, like I mentioned, that the one we issued in January has perhaps become stale but still usable. And so we have almost concluded work on the revised roadmap. The entire content of the one issued on 28th January stands and will be sustained. It's the thematic end date, start and end date for each of the project areas that will change. And so I want to assure the audience here, the participants, that before the end of next week, a new or revised roadmap will be issued to the industry. Now, we'll also issue guidance notes to insurers, and this will be done next year. Now, in the area of review and monitoring of implementation, implementation, we intend to request for and review quarterly implementation returns that we will receive from insurers and reinsurers. And we will also continue to review implementation updates and project status that will be sent to NICOM. We'll monitor the transition reports of insurers and also monitor all the adjusted SFPs and other financial reporting issues, the comparative issues, the disclosures that will be submitted in the course of the transition. And last but not the least, on the thematic schemes that we intend to do, I mentioned 4 of them. The last is harmonization directives. Now, we are aware that when standards are to be adopted, we from here, in collaboration or liaising with FRCN, we look at the standard, and then it is also, as you are aware, that it's not as if all the letter of the standard must apply to a particular jurisdiction. There are some local nuances that may require that certain things either be improved upon, regulatory issues be taken into cognizance, and so we'll issue some mandatory exemptions, some optional exemptions and choices, and then any other directives that may be required or that may be thrown up as we progress in the course of the transition will be issued to the market. We intend to engage the market and collaborate with the market and collaborate with the advisors of the market as far as possible. And to this extent, we started early this year, wherein the Commissioner for Insurance inaugurated the Insurance Industry Financial Reporting Working Group with membership cutting across the Big Four firms, the NIA representatives, the NICOM representatives of FRCN, and also representatives of the Actuarial Association. To the best of my knowledge and belief, if we all work with the roadmap and with this plan, both from the Commission and from the industry, we want to believe that yes, we have just 2 years to go, just as was mentioned to us by Mr. Sam Abu, that if we put things together and work earnestly, we'll be able to achieve this. Internally in NICOM, we've also commenced rejigging our IT processes, and that's where we have also moved to the level of the IT automation. And we believe that in the course of the transition, all IT processes will be stabilized and automation work will be stabilized. This we have as a message to give in throwing light on the regulatory perspective and expectations of the National Insurance Commission in relation to IFRS 17 adoption. Thank you very much. Thank you for listening.
Thank you very much, sir. Thank you for also letting us know the plans of the Commission and how you're planning to support and the different work that you're doing behind the scenes. We really appreciate the proactive stance that the Commission has taken. Thank you. Welcome to our participants that are joining us for this Getting Ready for IFRS 17 webinar being held by PwC. We're happy to have you here. We're now just moving on to the section on overview of IFRS 17. This section will be taken by one of our directors, Uloma Ojima, who works in our accounting consulting practice. And the idea of the session is to just help for those who may not fully have sort of entered, the different areas of IFRS 17, a foundation basis to sort of take us through the rest of the day. Uloma, please, over to you to take us through an overview for the next 15 minutes. Thank you, Uloma.
Thank you, Bolali, and good morning again to all our participants online. So over the next 15 minutes, I'll be taking you through a high-level view of IFRS 17. So just as an introduction, the question is why IFRS 17? And IFRS 4 was basically like an interim standard. And if you recall, when we transited to IFRS in 2019 and when we transited to IFRS, we basically did not have much changes in the way we measured our insurance contracts because IFRS 4 allowed you to continue to use whatever methods that you were applying in your previous GAAP. But now moving to IFRS 17, there will be some major changes. And that is what I have highlighted here on the right side of the screen. Some of the major changes would involve how the insurance contracts are being measured. So now you'll be required to measure your insurance contracts using a current value. So every year, our estimates will be updated considering what has changed, considering market indices, and then considering changes in our expectation on how this contract will be played out. And then this will now be reported on a discounted basis. So our current estimate of future payments discounted to the present value. Also, IFRS 17 helps you to understand profitability on the contract. So both your current profitability and also how this contract will play out in future. Now, when we go through a bit more detail on the measurement model, you realize that the way you recognize insurance revenue will change significantly. Currently under IFRS 4, we normally use our premium received as our basis to determine revenue and ultimately profitability for the period. But IFRS 17 requires you to do more like an amortization of your revenue over the lifetime of the contract. So you are looking at the fulfillment cash flows. So what will it take you to fulfill your insurance contract over the life of the contract? You're looking at your inflows and then also the payments, the claims that you expect to incur on those contracts. Then you determine your overall profitability on the contract, and then you recognize it over the insurance period as you provide the insurance coverage. And this tends to align more with the IFRS framework as a whole, because the IFRS framework tends to move towards looking at the lifetime of your contract. They are not just looking at what you receive in the period. They are saying over the life of this contract, how will the contract perform? Will there be losses? Will there be profits? And then where there are losses, you recognize them immediately. And then where there's a profit, you defer it until the period in which you actually earn those profits, which means as you fulfill the contract. So that is one of the main drivers of IFRS 17, to ensure that IFRS 17 and the way we measure insurance contracts align with the fundamentals of the IFRS framework. And this would ensure that insurance contracts are measured consistently from period to period and from company to company and across different jurisdictions. So looking at the scope of IFRS 17, it covers your insurance contracts issued, which would include insurance contracts issued by core insurance companies or any company at all, and then also your reinsurance contracts issued, which are basically insurance contracts issued to an insurance company. So your insurance contract issued, the insurance contract issued, and then the reinsurance contract that you hold, and then also lastly your investment contract with discretionary participation features. So the scope did not really change from what we have under IFRS 4. So we expect that in general, most of the contracts that we had within scope under IFRS 4 would also fall within scope of IFRS 17, except for maybe a few exceptions here and there. But in general, even from experience and from the implementation project that we started so far, we've not really experienced so much differences in scope from what we had under IFRS 4. Then for your fixed fee service contract, so this would be relevant for, let's say, health insurance companies. So it could also be, you could also have some other insurance products that when you analyze it, you realize that you're basically offering to provide a service to the customer for fixed amounts over a period of time. So things like your maintenance contract, some of your health insurance contracts. For those contracts, you have a policy choice to either apply IFRS 17 to them or to measure them using IFRS 15. And IFRS 15 is the standard that deals with revenue recognition. So in applying IFRS 17, you need to first look at your contract to determine if there are other elements that are embedded within that contract that needs to be separated, and then you basically isolate just the portion that is subject to core insurance risk. So this is a high-level flowchart that you consider. So looking at the contract as a whole, does it have insurance risk? If the contract qualifies as an insurance contract, but then there may be other embedded benefits and clauses in there, you need to consider if some of these meet the requirement to be separated. And some of these could be investment components. So you could have insurance contracts that have a guaranteed return. So some of those guaranteed returns, by the time you look at them, you might realize that they are not really subject to insurance risk, but rather they are like an obligation to pay over a specific amount. So those would be distinct investment components, and they will need to be separated and measured using IFRS 9, which is the standard for financial instruments. You also need to consider if there are embedded derivatives within the contract. So these will be cases where you have an insurance contract, but the cash flows or the payouts on those contracts might be dependent on an underlying market indices. So in those cases, we find that such contracts are not just exposed to insurance risk, but they are also exposed to certain market risks. So where you have such in your contract, they will also need to be separated and measured in line with IFRS 9. Then you also need to consider if there are any service components within that contract, and consider if those service components are distinct in nature. If they are, they will also need to be separated, and the service components will be measured using IFRS 15, which is your standard on revenue recognition. So this would apply where you have products that provide insurance cover, but also provide some other service benefits or even goods benefits. So those would need to be separated and measured separately. So by the time you've done all these separations and you've isolated just the portion that is core, that is the core insurance component of that contract, that is when you now begin to apply your IFRS 17. And the first thing you need to do is to determine the level of aggregation, which I'll look at in the next slide. So your level of aggregation basically means the level at which you are doing your IFRS 17 determination. So the level at which, for sake of argument, let's say the level at which you will determine profitability on those contracts. When you determine the level of aggregation, so those are like your units of account, then you now need to look at those units of account. What measurement model should they be? Should you apply to measure them in line with IFRS 17? And there are three basic measurement models, which we'll look at shortly. So when I talked about level of aggregation, there are three, apologies for that, the light just went off. So there are three basic considerations in determining how to group your contract. The first one is looking at the portfolio level. So here you will group your contract based on the shared risk characteristics and also how those contracts are managed together. So in our environment, I would expect portfolios to be looking at general insurance, for instance. Your portfolios might be fire, motor vehicle insurance, marine, flood. So looking at portfolios that have similar risks, and then also looking at it from the company's perspective, how do they manage those contracts? So you could have contracts that have similar risks, but they are managed separately for some reason by the organization. Then in that case, you need to go below the level of shared risk and also consider how these portfolios are being managed within the organization. So when you determine your portfolio, then you need to go further and break down each portfolio into three different subgroups based on profitability. And the groups would be, number one, contracts that are onerous at inception. So which means for this contract, you expect to incur a loss over the lifetime of those contracts. And then you also consider contracts that at inception have no significant possibility of becoming onerous, and then other profitable contracts. So it means you're looking at onerous contracts, contracts with no significant possibility of becoming onerous, and then contracts that are profitable, but with a likelihood of becoming onerous over the life of the contract. For the onerous contract, you recognize the losses immediately in the profit or loss account. So as you book those contracts and you do your valuation and you compute those losses, you recognize them in your P&L immediately. For the other two groups, which is your profitable contracts with no significant possibility of becoming onerous, and then other profitable contracts. For these ones, you determine the profitability, which is what we call the contractual service margin, and then you defer it and you recognize it over the life of the contract as you provide insurance coverage. And then one further consideration is the annual cohort. So after determining each group within each portfolio, you now need to break it down further into contracts that are issued in the same year. So you cannot have contracts that are issued more than 1 year apart in one unit of account. So by the time you do all this, you might find out, depending on the nature of your business and the size, you might be having hundreds and thousands of units of accounts. And this is why we keep saying, for you to fully comply with IFRS 17 going forward, you may need some type of system solution, because it may not be feasible to do a manual computation and recording of each of these units of accounts by the time you have so many based on the annual cohort. So after determining your units of account, you now need to consider which measurement approach should be applied on each unit of account. And there are three measurement approaches. We have the building block approach, which is the general approach. We have a simplified approach called the premium allocation approach, and then we have the variable fee approach. The building block approach is the default model for all insurance contracts, and it is mandatory. However, if you have contracts with a short lifespan, and this is we consider this to be contracts that are 12 months or less, then you have the option to use the premium allocation approach. The premium allocation approach is similar to the unearned premium reserve approach that we currently use. So what you do is that you basically defer your premiums and then recognize them on a straight line basis as the insurance period elapses. Then there's a third approach, which is the variable fee approach. The variable fee approach is a modification of the building block approach, and this is applied to insurance contracts that have discretionary participation features. And these are basically contracts where the policyholder shares with the insurance company some underlying assets that are linked to that contract. So the performance of those underlying assets are monitored, and it's shared between the policyholder and the insurance company at an agreed ratio, subject to certain criteria that you need to consider. So if you have a contract, an insurance contract with discretionary participation features, then it is mandatory, you must apply the variable fee approach. However, the premium allocation approach is optional. So that means if you have a contract that is 12 months or less, you can still decide to go ahead and use the building block approach for it. So the premium allocation approach is just to make things easier for insurers, but it's an option that you have to take if you think it's be beneficial for you. So I'll look at the three measurement models high level. So the general model, which is the building block approach, there are 4 building blocks that we consider when applying this. The first thing to start with is your best estimate of fulfillment cash flows. So this is basically looking at an explicit, unbiased, probability-weighted estimate of the fulfillment cash flows that you expect on that contract over the life. So this would include things like your premiums that you receive on day one and the premiums that you expect to receive over the life of the contract. Things like your expenses, both your direct and indirect expenses, so your commission, your allocated indirect expenses, your claims, and basically looking at any other cash flow that you expect to incur over the life of the contract. So you determine that over the period of the insurance contract, and then you do your probability weighting. So you consider different scenarios and then you get your net cash flow. You discount that to the present value using an appropriate discount rate. So when you get that, when you get that, you now consider what we call the risk adjustment. So this is basically the compensation that the entity expects to get for bearing risk over the life of that insurance contract. So that risk adjustment is like an income to the company. So by the time you consider the risk adjustment and you deduct that from your discounted cash flows, whatever is left is now your profitability on that contract, and it could be positive or negative. So when it's positive, that means you expect to get more over the life of the contract than you are giving out. And then you've also considered your risk adjustment, which is your risk compensation. And after deducting that, you still have its profitability on the contract. So where it's a profit, it's called the contractual service margin. And like I mentioned earlier, that will be recognized on the balance sheet like an unearned income, so almost like a liability. And then you amortize that and recognize that as insurance revenue over the life of the contract. However, if it's a negative, which means you expect for the contract to be loss-making over the life of the contract, then you recognize that in your P&L as a loss at inception of the contract. Yeah. So then I already explained the premium allocation approach, where you recognize your premiums received as unearned premium, and then you amortize them over the life of the contract. And that is for your unexpired risk. And then for your variable fee approach, that is basically a modification of the building block approach. So if you're applying the variable fee approach, you will still need to go through this whole modeling exercise, determine your contractual service margin or your loss on the contract. But there are certain variations or certain things that will need to be adjusted, things around the rates to use, and also how to fair value and treat the underlying items which the policyholder is sharing with the insurance company. So when it comes to the adoption timeline, like Mr. Baraneka mentioned earlier, it was revised this year by IASB. So the standard is now effective for periods beginning 1st January 2023. So for insurance companies in Nigeria that report using December year, that will be our full financial statements for 31st December 2023. But however, we just wanted to point out that remember your quarterly reporting for 2023. So it means our first IFRS 17 compliance report should be for Q1, 31st December 2023. And the key dates to consider for that would be your opening balances. So come December, we would have IFRS 17 numbers for 31st December 2023. We would have our comparatives in IFRS 17 compliance for 31st December 2022. Then we would also have our opening balances for 1st January 2022. So we're looking at those 3 days. But for your 31st December 2023, you would also need to have comparatives for Q1 of 2022. So that will be 31st March 2022. And then you would also need your opening balances of 1st January 2022. So in essence, we are looking at running IFRS 17 numbers to begin with for at least these 5 days. 1st January 2022, 31st March 2022, and then of course the subsequent quarters up until we get to your 1st January 2023, and then you transition fully to IFRS 17. And then come December, we have our full financial statements for December 2023, showing comparatives for December 2022, and then our opening balances for 1st January 2022. So this is a summary of the overview. And just to mention that for transition, you are expected to do a retrospective application, which means for 1st January 2022, we would apply IFRS 17 on all the contracts in force at that date, as if we have always applied IFRS 17 from the beginning of those contracts. However, where it is impracticable in certain cases to do a full retrospective application, there are simplifications that the standard allows you to use. to manage that process.
Okay, thank you, Uloma. So, Debo, please just take us through what is changing between IFRS 4, which is what insurance companies are currently doing, and IFRS 17, sort of looking at the recognition measurements as well as the disclosures. If you can just spend 10 to 15 minutes just running us through that. Uloma has already gone through quite a number of areas already, so we just want to focus on the actual changes to get our insurers prepared. Thank you, David. Thank you, Debo.
All right. So good morning, everybody. I'll just take us through what is changing. The basic essence of this is for us to be able to see currently we use IFRS 4. And so we're actually very comfortable and understand what is required on IFRS 4. So it's also good for us to see what is changing with IFRS 17 so that we can know the key areas that we need to focus on as we go on the IFRS 17 journey for most of our companies. Now, the first thing to look at is recognition, where we talk about the level of aggregation. So Ulama talked about level of aggregation. Currently under IFRS 4, what we basically do is consider portfolios based on their similar risk. So we look at different contracts, for instance. So we have a portfolio of motor insurance or fire insurance, and then we look at them basically on that level. Now, what happens is that we don't consider profitability, we don't consider other things that IFRS 17 is using. What then happens is that we are able, currently under IFRS 4, to offset profitability across different, using contracts with different, within similar risks. So, for instance, if you have multiple policies where some of them are actually profitable and some of them are not profitable, the fact that we are merging them together means that the profitable contracts will actually offset the unprofitable contracts. And this is one of the things that IFRS 17 seeks to correct. So what we'll see with IFRS 17 is that the level of aggregation requires first that we have similar risk, right? Which means that yes, you might still continue to look at our portfolios such as fire, motor, engineering, and all of these different portfolios. However, the other part of it is that we also then need to consider profitability. So within that bucket, we also need to consider contracts that are onerous. We need to consider contracts that are profitable without risk. With no risk of becoming onerous and other contracts. This means that we need to pay more attention to how we determine the profitability of all of these contracts. So the question then is, how do I determine a contract that is profitable versus a contract that is not profitable? So these are some of the considerations that IFRS 17 introduces. The impact on this basically is that, yes, whereas we have systems currently that allows us to bucket our risk based on the class of business which we currently do. The impact is that we also then need systems that allows us to be able to partition by profitability level and also the years that those contracts started. So we also consider cohorts of policies and when did they start. So contracts that are 1 year apart would be separated from each other. So our systems, our data requirements, the processes that we have internally need to start speaking to these sort of requirements that IFRS 17 is introducing. Secondly, I will look at measurement also under IFRS 4 versus IFRS 17. So Ulama has spoken to the building block approach, which we also call the general measurement model. Currently under IFRS 4, which currently uses local GAAP, we have on the 1 year contract, for instance, we have the local less year for acquisition cost. Now, when we consider the premium allocation approach, which a lot of people consider as being very simple to adopt, with a simplified approach, people consider it to be very simple. It's also very similar because what we're looking at is on the liabilities for remaining coverage, we look at the premium less acquisition cost, which is basically what we do under the current GAAP. However, the introduction, there's a new part where we have the liability for insured claims. So currently we have undiscounted reserves for past claims, including IBNR under IFRS 4. For IFRS 17, there's not the introduction of discounting. So there's first introduction of best estimates of those for payment cash flows. There's also the introduction of discounting, and there's also the introduction of risk adjustments, which we are currently not, a lot of insurance are currently not doing. Now, although people consider premium allocation approach as being a very simple approach, what you then, one of the things we need to consider is that these introductions, discounting and risk adjustments especially, introduces significant complexity when we're adopting this. So it's one area that we need to consider. In subsequent slides, I'm going to talk about discounting and risk adjustment in more detail, so I won't basically focus on it so much here. One of the things to also see is that, just to mention, is that for contracts that you expect to pay within a year, you might not necessarily need to discount. So this is why we have the PAA with undiscounted insured. So for the liabilities for insured claims for contracts such as that, where you know that, okay, we're not going to be paying for longer than 1 year, there won't be any need to have those discounts, to consider discounting. However, risk adjustments will still be considered. So the message here basically is that for a lot of companies considering the simplified approach for their less than 1 year contracts, they should also be mindful that there are also some level of complexities that have been introduced. Complexities such as risk adjustments, such as the discounting, and such as the fact that you need to still estimate your fulfillment cash flows. All right, so just taking it further, let's look at what happens to your best estimate cash flow. So currently under IFRS 17, for IFRS 17, we're expected to have expected cash flows that are current, they're explicit, they're unbiased, they're probability weighted estimate. Now this is what IFRS 17 requires. Under IFRS 4, especially for our life insurance contracts, we do this currently. I mean, we model and we consider what our best estimate cash flows are. So this is not a significant departure from what we currently do. However, there are some considerations that we must also be mindful of. One of those considerations are contract boundaries. There's a lot of definition around what the contract boundary should be. The time between which an insurer is actually allowed to price a portfolio of contracts. So we need to also we need to consider that. We need to consider how our system, our current systems interpret this on the contracts that we're writing currently. We also need to consider expenses. Now, IFRS 17 requires us to consider direct attributable expenses when we consider our business cash flow. Currently within the market, I know that expenses is a huge topic in terms of how we track expenses to the businesses we write. And so now that this is actually even required at a more granular level than we had under IFRS 4, it is one of the things that we should start engaging our IT guys and our system developers around how we, and then even our processes itself, to say how do we then track these expenses that are directly related to the contract that we are writing. So this is very key. There's also our insurance acquisition cash flows and then incorporation of our current estimates. Now, some of those things are currently being considered under IFRS 4. So of course we have contract boundaries, we have expenses, but the other complexity is coming from the fact that you now need to consider this at a more granular level. Remember we talked about the level of aggregation, so we need to consider it at those levels. And especially for expenses, which I mentioned before, that's actually a huge topic within the market. We need to then start thinking around how do we measure expenses that are related to the cash flows that we'll be modeling within any of the measurement models that we're using. Now, going straight to discounting. What do we see? So with discounting, IFRS 17, according to IFRS 4, when we have when we determine our discount rate, and I mean for the actual guys on the call, we realize that what we basically do is to consider the asset yields on the asset backing the investment, or the asset backing the cash flows that the insurance contract that we are looking at. Now with IFRS 17, we don't only consider the discount rate, okay, from based on the asset yield. We also then need to allow them to reflect the behavior of the insurance contracts or the characteristics of the contracts themselves. So what that means is that under IFRS 17, there is introduction of what we call the top-down approach for determining your discount rate, or the bottom-up approach for determining your discount rate. With the top-down approach, what we're basically looking at is first, we take the yield on the backing asset, which is currently similar to what we do on IFRS 4. But then, because you want that discount rate to reflect the characteristics of the insurance contract itself, you then also need to then back out the expected default, the unexpected default from those assets, and then look at any other mismatch adjustment before you arrive at the discount rate. Now, this is entirely different from what we do under IFRS 4. The other option also in determining your discount rate is to do what we call the bottom-up approach, where you look at the risk rate and then you consider the liquidity premium on that. Now, what this introduces is the fact that even for general insurance businesses, and guys are for us, those of us IT motor business, fire business, and all of that. Before, the discount rate wasn't a huge conversation for us. The life guys were more, we discuss discount rate more. But now we also need to begin to consider how do we determine this discount rate? How do we actually measure expected defaults? How do we measure defaults? How do we determine what the mismatch adjustment should be? All right. How do we measure liquidity premium, and how do we determine what the risk rate, and then how do we come together to actually determine what the discount rate should be applied going forward should be? So this is for me, this is a sort of a huge departure from what we currently do under IFRS 4. Insurance would need to consider which of these two approaches we want to use. So I'm not going to use the top-down approach, but we use the bottom-up approach, which is simple for us to use. Which of these approaches we already have information about that we can actually easily compute and use. And then for the different contracts that we have, we also need to consider systems and processes to do all of this. So do we have people that can do it? How often do we want to determine this discount rate? Do we have people that can do it? What process we need to put in place? How do we determine the liquidity premium? And then layered on top of that is, how much investment in systems will this? How much investment in systems will I require to do this? Can I even extend the kind of systems that we have or the service processes that we have? We need to calculate the discount rates on this for the group of contracts. All right. Next, we'll talk about in terms of changes. And from my perspective, I'll consider this one of the most significant changes that is introduced on IFRS 17. So currently, with IFRS 4, when we determine our risk margin, we basically use a lot of judgment. So I look at my discount rate, for instance, and I have the risk margin on it, or I look at my mortality assumptions and allow judgment for it to determine what the risk margin on that should be. That's currently what we do under IFRS 4. However, under IFRS 17, what is happening is that we need to consider the risk adjustment separately. So risk adjustment is considered to be a compensation for bearing uncertainty for the uncertainty around the amount and the timing of the cash flows that arise from non-financial risk. So we're looking at risks such as mortality risk, your lapse risk, your surrender risk, and all of that. Now, all of this needs to be calculated separately from how we were doing it before. So unlike before, what you could use a risk margin and then use your assumptions and then load some additional margins on your assumption. Now, what you need to do is to calculate this risk adjustment separately, all right? And it's explicit. So some of the factors you need to consider are things around, for the group of contracts that I'm even looking at, what are the diversification benefits on this contract? What is the, for the insurance company, what is the risk aversion? What is the risk profile? How do you view risk as an organization? All right. So all of this will be considered in determining what your risk adjustment should be. Also, the level of calculation, although insurance are actually allowed to calculate it at different levels. It could be a contract, be a portfolio, be a group of contract level. So, any of this could be considered for the calculation of your risk adjustment. Okay. Now, the next very key change that we'll see when we compare IFRS 4 and IFRS 17 is the contractual service margin, which Ulama has spoken about during the presentation. Now, compared to current practice, there's really nothing like this. This is a new concept for all insurance. So it's new, and it basically allows you to look at actually determining your end profit when you write your contract, and then apportion that on end profit across the coverage unit or the period where you're actually providing cover. So this is different. It's also very similar to what we have under the premium allocation approach, where you have an expired premium risk and then you apportion your premium over the lifespan of the insurance contract. Here, what we're basically doing is looking at the on end profit and then apportioning it over the coverage period of the insurance contract. And this has to be measured at initial recognition for each contract. So the level of granularity is also there. We talked about that before. There's a lot of data required to do this. I'm also looking at it from the point of what we currently do. So we need to, it means we do not basically consider, we have sometimes direct contracts, we don't consider either they're profitable or not profitable. We call them business vision sometimes. For contracts now, we need to know what the CSM on those contracts are. We need to determine that, we need to mention that the initial recognition, even at subsequent measurement, we also need to look at what is changing over time, and how does that impact on that measurement. There's also the area around the disclosure on your CSM. So we'll talk about that under disclosure. There's a lot of analysis that has to do with the changes in your CSM, which you also need to now start considering, which we're not considering previously. And the last part which I'll talk about is owner's contract. Ulama talked about this before, and this is actually, from my own perspective for the industry, this is one of the things that we need to focus on a bit. Currently, we have a lot of contracts that we know, like I said, are not profitable at inception. But we write them either based on business decision or either because we think that we can offset portfolios amongst each other. Now, with IFRS 17 and with measurement of CSM measurement, what would happen is that, number one, offsetting will not be possible because we're actually having contracts being aggregated at different levels. Okay. The second part of it is that there's also now the need for us to put more attention to how we price our products going forward, so that we can actually have profits and we can actually earn profits on those contracts as we run off those contracts during their coverage period. Okay, so I've talked a lot about what is changing and the additional work that is required. Now, but so the other thing I want to just mention is that it's not all additional work. There's also some very useful benefits. Extremely useful benefits for why we actually adopt IFRS 17. First on this for me is the fact that we can now compare to, and when we look at it compared with IFRS 4, we can now compare our contracts more effectively. So even with contracts, we currently, when we write annuity contracts, and there are different accounting treatments between two different insurance companies, for instance, on annuity contracts. So we see some people passing in the lump sum as premium income, and then passing in some under, and passing it out again under reserve and all of that. So there are different treatments. But with IFRS 17, there's a consistent way to actually report and measure even insurance contracts. Either you're looking from the life or from the general insurance angle. So this is one thing that is changing IFRS between IFRS 4 and IFRS 17, which is a very good one. Once you do it, doesn't require any additional work again. It's done. You know that now you can actually compare contracts more effectively. The other thing is that, for companies that are, part of subsidiaries or part of bigger groups in other countries, what you also see is that you can now begin to compare your results with the results of other jurisdictions. So if you have, if you're a subsidiary of a company in the UK or South Africa, for instance, it's easier for you to look at the two accounts and then compare effectively what the insurance company in Nigeria and what is happening and the insurance company in South Africa or UK is doing. And so this is one of the very good introductions with the IFRS 17, which under IFRS 4 we didn't have, because IFRS 4 was actually using local gaps across different countries. The other part of it is also the fact that we can also compare across industries. So we previously, when we would take a revenue and almost look at that as income and say, oh, I've made a 50 million gross premium, so I'm a good insurance company, I'm a profitable insurance company. Now we have across different industries, we can actually measure profitability as services are being provided. So it means that you can actually say, okay, this is exactly what I've had, given how long I've provided coverage for, and which is actually good, which is actually a way where we can actually begin to compare insurance companies with maybe other companies that other industries that do the same thing currently. All right. So what else is changing? I know that I've spoken to some of this before, but I'll just quickly look at it again. So what else is changing? First is, we talked about gross written premium before. This would no longer be in the financial statement. Now we have insurance contract revenues, which would actually relate to what you expect when you price the product. So when you price the product, what is the CSM, what is the risk adjustment, and all of that. Now, all of this together, so you have what your expected benefits should be, what your expected expenses should be, what your amortization of your CSM should be, what your risk adjustment should be. All of this would form the insurance contract revenue going forward. So that top line, called gross written premium, would effectively disappear, especially for insurance companies that are writing the life businesses. It will still be similar concept for the companies writing GI business, because the premium allocation approach will still be applied, and it looks very much like what we currently do under IFRS 4. But for life insurance companies, there'll be a significant change in terms of what we currently look at as our gross written premium. The operating results will also change. Why? Because there's a lot of influence from what you have as a insurance service result and the insurance investment result. So this will actually drive what your operating profit should be. So remember that now we're talking of the discounting, we're talking of CSM, we're talking of all of the risk adjustments, we're talking of insurance contract revenue. So which means that your operating results would actually differ from what you used to be under IFRS 4. Also looking at your returns on equity. This is one area where I know that a lot of finance companies are concerned and to say, look, what's going to happen? The truth is that, yes, some of the key variables, your net income, your equity, some of the key variables that we actually use in computing your returns on equity will change, which means that your return on equity numbers will also change going forward. And then also the analysis of change in CSM. So one of the key areas that you would want to measure for insurance companies will be how you're seeing changes in your CSM. So your CSM, remember, is the profit that you expect to earn on those contracts. Now, how that changes, as you see your current estimates and you see your assumptions changing, will be a very, very important factor that a lot of insurance companies will now need to disclose and show to the management and to the owners of the company going forward. Okay, so finally, we'll just quickly touch on disclosures. So what's happening with disclosures now? So compared to IFRS 4, what we've done here is to highlight the key areas that will be changing in red. So, let's look at under the amount. So currently, under your income statement, you would have things like your underwriting revenue, underwriting expenses, financial income or expenses. You currently have all of this under your income statement now. Now, with IFRS 17, there are additional disclosures that you need to make. So you have reconciliations of your present value of the probability weighted cash flows. You have reconciliations in your risk adjustment. We talked a lot about CSM, both for the general model and your variable variability approach also. You need to disclose all of that. And your liability for remaining coverage under your premium allocation approach also needs to be disclosed compared to what you currently have under IFRS 4. There's also, like we said, a lot of judgments that IFRS 17 introduces. So we talked about discount rates, we talked about your owner's contract, and we talked about confidence level, even for determining your risk adjustment measurement. So all of these judgments would also need to be disclosed. So you need to disclose judgments around the method you use to calculate your finance income, judgments around your confidence level for your risk adjustment, judgments around the good calls that you have used would also need to be disclosed, amongst other judgments that you might also need to disclose. And then with your risk, your nature of risk, exposure, all of this will become a very key part of the disclosure that you need to make under IFRS 17 compared to what you do currently under IFRS 4. All right. Thank you. I'll just hand over back to Bolanle at this point.
Thank you. So, Christian, we've heard a lot about the theoretical side of IFRS 17. And what we want to now do is based on all that we've heard and the implementation challenges that we've encountered with helping some of our clients, I'm going to hand over to both Rilwan and Christian to sort of take us through some of the implementation challenges so that we can start thinking planning ahead for when we all start sort of fully implementing IFRS 17. So over to you, Ruwan and Christian. Thank you. Christian is an actuary in our South African firm. He's a partner and heads the actuarial practice there, and he supports IFRS 17 and other actuarial services. And Ruwan is an experienced manager in our local actuarial practice in Nigeria and sort of supports other parts of Africa as well. So over to you two. Thank you.
Okay. Thanks, Bolanle. As we heard all morning, IFRS 17 is a game changer. It doesn't just affect the way we report our financial statements. It also affects the way insurance companies will be measured going forward, subsequent to implementation. It affects generally the organization as a whole. From what we've seen in our implementation support, organizations are beginning to think about new ways of doing things, as well as trying to find ways to ensure that the processes, the systems, the data are in compliance with what IFRS 17 requires. For example, like Debo mentioned, the KPIs for insurance companies will change significantly. There will be less focus on gross written premiums and more on underwriting profits. And that means that onerous contracts are now more pronounced, and with that comes a huge challenge with our market, in that the current practice of using tariffs for our non-life insurance business then need to be reevaluated to see if they would then support the business when we start reporting under IFRS 17. Now, because of these numerous complexities that IFRS 17 brings to bear, then it brings up a lot of implementation challenges, as we've been seeing for some of the clients that we've supported. Now, some of these challenges start all the way from when you determine your unit of accounts and portfolios, all the way down to when you determine your disclosures and your financial reports. Now, for our market, these challenges are more pronounced because for the more advanced markets, and Christian will share more insights into that, they already have, where you've already implemented Solvency II, then you have some leverage over what has already been done on Solvency II. Now, for our market, where we had not adopted Solvency II prior to now, except for specific insurers that have chosen to do that on their own, then it means we do not have the advantage to leverage on what has already been done under Solvency II, and we need to start from scratch. Meanwhile, the other insurers, the insurance companies overseas can leverage on what they've done under Solvency II. So the challenges for our market in Nigeria is really, really enormous. So I'll hand over to Christian to just take us through some of these challenges that typically we would face during an implementation of IFRS 17 project. Christian.
Thanks, Rowan. And good morning and good afternoon, everyone. So as Rowan said, I will try and go through some of the really practical implementation challenges that we found, and that really stems from our experience over the last 3 years. So just for some context, I led two teams implementing IFRS 17 at two large insurance groups over the last 3 years. And as the first slide shows, this will really impact every stakeholder in the company. I'm not going to speak directly to the slides, but rather try to isolate five key lessons that I think is worth keeping in mind. So the first one is, and this has been said before, but I cannot stress this enough, is that one should not underestimate the size of this challenge. So many of you will be familiar with IFRS 9 that was implemented at the banks. You may have heard some war stories of what they went through to get IFRS 9 over the line at the banks. And having been involved in quite a number of IFRS 9 implementations as well, I can tell you that IFRS 17 is multiples more complicated, and it's going to take way longer than something like IFRS 9. I really like the quote that Sam mentioned right in the beginning, and really want to echo that in this point. If you haven't started 3 years ago, the second best time to start is really right now. This is exceptionally complex. It's by far the most complex life insurance matter that I've dealt with in my 20 years of consulting experience, and it's going to take a lot of time and dedicated effort to implement this. So why is this different to something like IFRS 9? Why is it so complicated? I guess that brings it to the second point, and many of us will be familiar with kind of finance transformation programs in various ways, shapes, and forms. But I guess if I try and bed down why this is different, it is because this is not a sequential process. It's a really iterative process. So when we started with IFRS 17, we all came with it from the angle of, okay, how are we going to tackle this? There's a new standard. So first thing we do is we do a gap analysis. Then we do some sort of financial impact assessment. And then from there, we just work to close all the gaps. And at the end, we're done. So IFRS 17 does not work where you start with a gap analysis, you do an impact assessment, and then you just close the gaps. Because every little thing impacts every other thing. So there's a continual back and forth between setting your policy and methodology. But now within your policy and methodology, you have a whole range of options that you can take as an example. So now, depending on the option you take, you need will have a different financial impact. So now you have to pick an option, determine the financial impact, but also then maybe test the financial impact for another option, and then you go back. So then you're back to square one. So it's really an iterative process where you will feel like you go around in circles for a while. You cannot just simply do this step 1, step 2, step 3, step 4, step 5. Then you are done. So the best way we found. And this is not just in our project, but many projects globally that's been successful have found this to be a good way of getting around this, is to not sit in a nice air-conditioned room with the whole project team and go through a gap assessment, but actually get down, get in the trenches and try and implement it for a product. So do a pilot, which you can also see as a very deep dive operational gap analysis. Do it. Try and get the data. See what data isn't there. See if you have all the calculations that you need. See what data you need to actually calculate the results. And through that really is the quickest way to learn, as opposed to this gap analysis approach. Third point, third big lesson learned is that there's definitely a distinction can be made in terms of projects that's been more successful compared to less successful is just the way they've set up their projects. So I think, again, we depend, and this depends on the organization, but some organization really works in silos from each other. So you have your technology, your IT department, you have your actuarial department, you have your accounting department, and it's kind of handed from here. You get data goes to the actuaries does a lot of calculations with it, then it goes to the accounting, they put it in the ledger, and ultimately they do the reporting. If you tackle IFRS 17 in that way, I think that the probability is that you are going to fail more than you succeed. Everything, as I mentioned before, every single thing impacts almost all three areas. Yes, it's a big data exercise, but you maybe need the actuarial and the accounting know-how to know what data it is, and then you need the technology guys to actually go and get the data for you. You really need to work with blended teams. If you have to separate them, A little bit, I guess the tech aspect can be slightly separated, but certainly accounting and actuarial have to work really, really closely together. So we actually came up with a saying on one of our projects that you don't need an accountant or an actuary to implement IFRS 17. You actually need accountants. So you really need people that understand both, ideally in one person, or if you can't have those skills in one person, you need to let the teams work very well together. But the accountants will have to understand more of the actuarial world and vice versa. So the fourth large lesson learned is we've been speaking a lot about changes to calculations, changes to disclosures, and all of that is correct. I think what companies underestimate is what a big data exercise this is. So just to give you an idea, so we've spoken earlier about the new unit of account being groups. So everything will be done at a group level, and depending on the type of organization, you may have hundreds or possibly even thousands of groups of policies that you have to calculate numbers for, and you need to track them. You need to keep the data from last year and previous years and do it all again in the current financial year. Now, if it would have actually been in retrospect maybe good to have a quick poll if I asked the audience how many data items would they guess every group is required to have for you to be able to do IFRS 17. Now, this is based on a general measurement model with reinsurance. But the answer to that question is that you need almost 1,000 data items to be able to do IFRS 17 just for one group. So now you can quickly multiply out those numbers in your head. If you have up to 1,000 data items in a group, and you have to do this for multiple groups, and you have to save information over time, it gets really, really complicated quite quickly. So yeah, there's a lot of other implementation challenges on the slide. All of them are very valid, but I thought I'll just highlight those 4 or 5 key ones that we have found in our particular projects. Back to you, Rowan.
Okay, thanks, Christian, for that insight. So we're going to move straight into the solutions section. PwC offering in terms of how PwC can support with IFRS 17 implementation. As Christian just said, considering the amount of data that you require for IFRS 17 implementation and how to bring all that together from different aspects of the business, all the way from underwriting, actuarial, accounting, and investment and all that, to bring everything together to prepare IFRS 17 compliance financial statements. It is almost impracticable to actually comply with IFRS 17 without some form of tool, accelerator, or even a system. And now, some of these tools around are designed to help you transit from NGAP and bridge the gap between NGAP and Solvency II. Some help with preparing your data. Some help with just helping you report with IFRS 17. And for the non-life insurance companies, some help with calculating just with the premium allocation, reserving using the premium allocation approach and all that. So there are numerous tools that are out there. But in PwC, we focus on taking that headache of bringing all that process and that data together. We focus on taking that out of your hands and the information process out of your hand. And we do so by leveraging on these experiences that Christian has shared. So leveraging on these experiences that Christian has shared and that we've gotten all around the world, we've put them together to build our solution offering. And as of today, I'm happy to tell you that PwC solution is the only fully compliant solution that you would share that you would see globally. And while we have no reason to believe that other alternatives will not become fully compliant, we know time is of essence, and this is really important for insurers. So irrespective of your approach to implementation, irrespective of your approach to implementation, PwC has a solution that can support you. And we have this in two folds. The first is our managed service. The managed service typically just take the entire headache of IFRS 17 implementation out of your hands. We work with you to get the data in place, and then we use our managed services to help you with generating the report. The output of that process are the double entries, debits and credits for each of the at the unit of account level, based on your own pre-configured chart of accounts, and it also populates all the disclosures. Christian would talk us through that in a moment. The other option is our IFRS 17 in a box solution, which is a plug-and-play solution that can fit into any architecture. This is fully compliant and has been certified internally by PwC and also external, independent external parties. Now, over the next few minutes, Ark would take us through IFRS 17 in a box and what it's about, and then Christian will come back and take us through managed services and how we can take the entire IFRS 17 process out of your hands. So over to you, Ark. As an intro, Ark is an associate director with our PwC office in Poland. Is one of the drivers of this IFRS 17 in a box solution. He's had experiences all around the world in Asia, America, Europe, and Latin America, Europe, and the Middle East. So Ark will take us over the next few minutes through what IFRS 17 in a box is all about and how it can help you with your implementation project. Over to you, Ark.
Thank you. Thank you, everyone, for that short intro. So I will try to really, in a nutshell, summarize what we believe a key challenge in actually choosing the system is and how we respond to those challenges with our own PwC solution. As an introduction, I'm very proud to see that it's not only us thinking highly about our solution, but this solution has already been reviewed by external party, being a Chartis company that compares majority of the solutions available in the market. And the solution that I'm going to present in a minute has been ranked #1 among all solutions designed for IFRS 17 implementation. So we are very proud of it, and hopefully that would work to our client benefit. So if we move to the next slide, when we talking IFRS 17 implementation, you might think it is an, let's say, CSM calculation, but actually if we break it down into the blocks that you already need to implement, specifically given what has been said in the beginning that in your region you cannot benefit from already existing, for example, Solvency II models, that means that IFRS 17 implementation address the full breadth of the activities that need to be undertaken. So if you were to do it fully on your own, what it means for you. First, you need to read the standard, you need to translate it into your business requirements, you need to build a data model, so basically design a set of data required to deliver the calculation. Based on this data, you need to build a cash flow projection models. And here, this is the main leverage coming from Solvency II, because majority of companies in Europe that I'm working with, they already have existing and well-tested cash flow models. If there is a first regime that requires that detailed cash flow modeling, it is a quite extensive exercise. Then the next block is a cash flow, is using business transaction data and cash flow and calculate IFRS 17 metrics. So items like risk adjustment, CSM, and all others required to do disclosure. And people tend to think that that's basically the end. As you see in the slide, it's just at best, it's a half of a journey, because what you need to do next is design a translation between calculation engine result to accounting postings, so debits and credits. You need to design your subledger as how you would store, at which level of aggregation the debit and credit would be stored. You need to design the alignment with your general ledger. So basically, modify your general ledger in order to incorporate posting that will be coming from subledger to your existing general ledger. Not mention the consolidation, if that would be also part of the IFRS process on your end, and obviously disclosure management, in a sense, what level of granularity you want to disclose and to what extent you feel comfortable with the number disclosed. So you see there are quite a long list of items to be addressed in line with IFRS 17 implementation. And that's why we came up with the solution that basically takes out the headache of you from majority of these items. Because in theory, you would, I try to pick the, okay. Okay, so in theory, you would have two options to do that. You can work with either on your own or with an advisor on designing everything and just buy a platform that you would code everything on your own. But pointing to what Christian said in the chapter ahead of it, basically, the sooner you will get to the calculation result and test value option, the more likely you are to succeed. So right now, if you decide to spend a majority of your precious time on building and designing algorithms for loss adjustment calculation, for CSM calculation, it might be quite interesting exercise, but it took us around 2 years to have it ready. And basically, it is a point on which you can already start with. And there is quite a lot to be done once working with the ready algorithm in order to pick relevant accounting choices, test it against financial impact, see what are the data implications, and so on. So our approach that is reflected by this solution follows the strategy of using existing solutions that we have developed, of translating standards into ready algorithms, and already accelerating the full implementation, jumping already to the point where a majority of European insurance are, not rather starting with the point where insurers were 2 or 3 years ago. And coming on what that means in practice in terms of what we have covered within IFRS 17 in box. So we believe we designed the solution, as was also scored by Chartis, that covers the more breadth part of the IFRS 17 value chain. So basically, it starts with cash flow projection for non-life insurance companies. If you are a complex life company, we would expect that you would have an external cash flow generator. But if you write a simple P&C product, this solution can already generate required cash flows for IFRS 17 calculation. It captures your transactional data and basically cover all the steps required up until the point you post your debits and credit to your general ledger. So it captures it can serve as a fully fledged subledger based on which you can visualize all mandatory disclosures within Tableau report prior to uploading them to your general ledger. It's all governed by embedded workflow engine, and it also has internal database that stores all your data input and all data output that has been historically calculated or ingested to the solution. So these values are always available to you. So in terms of the actual software, we have a very limited time, so I would focus on let's say the key key differentiators of our solution, and instead of talking through the slides that I'm just showing, I will move to application itself, at least for 5 minutes, to give you a look and feel of the application we developed. So hopefully you can see the application, and I've started with the reporting part. So any calculation that is performed within our solution generates a result that can be visualized in a form of a mandatory disclosure. So it's no longer a pure set of the output variables, but it's actually a workable visualization of all your disclosures. So for example, if I look on one of the first, which is a new business initial recognition, I can understand how my CSM has been built as a result between a discounted inflow, outflows, plus risk adjustment amortization and acquisition cash flow amortization. It also allows me to drill down on slice and dice the result as I deem fitted, using not only IFRS 17 dimensions such as unit of account, but also dimensions that more reflect your business perspective, which is not necessarily an IFRS 17 view. This solution also deals with the business transactions. So that means that is what you can visualize. It's not only items that have been calculated within the solution, but also captures for a business transaction, so that you can form a full, as you see here, full profit and loss and full balance sheet of a company. So that's on the part related to visualization. I talk about a full subledger functionality, which is also one of the key differentiator of the solution offer. And here, important aspect is that this solution comes not as an empty platform that basically you can use as a subledger, but we ask you to populate with your chart of account that you need to develop on your own. On the contrary, we have already pre-populated with PwC configuration, including all, as you see, chart of account, which is composed of more than 1,200 entries, and all up and running accounting schemes for all measurement methods that can be easily and intuitively changed by yourself from a user interface. So any changes to accounting scheme, any changes to chart of account can be made out of the user interface, and also connecting to your general ledger, adopting appropriate taxonomy also gives you the possibility to change it from user interface. So full subledger functionality that can directly interface with your general ledger. The next two items I would focus on is the full workflow engine. So any process you enter in the solution itself is disaggregated into easy and intuitive to understand steps that need to be completed and reviewed by different users based on the roles and responsibilities assigned in the admin panel. And coming back to process itself. And once all these tasks are completed, you can run the calculation that generates the output variables and generate debit and credit. Important thing is that this solution, so we as an audit firm made a huge effort to make this calculation process and results fully auditable. So the calculation task is followed by extensive calculation audit trail report, where basically you can in Microsoft Excel basically report based on the interim results. You can rerun and reperform all the calculation results as you see in calculation output, and the accounting steps being followed by the accounting audit trail, where you can have full details on the postings that are generated to your general ledger, and you can obviously preview it prior to exporting it to general ledger. The last point I would mention is the fact, even though it is an in-the-box solution, so it's ready off-the-shelf solution with no need to implement your own code, we have made an effort to make it as flexible so that we can accommodate all your accounting choices. So, for example, if I do the test data, I can through the settings exercise, I can pick the relevant measurement method, which is then followed by all optionalities that have been prescribed by IFRS 17 standard, including latest exposure draft that gives certain additional optionality on the risk mitigation technique, for example, here for the VFA. So all of it, as I say, is governed through embedded workflow engine. No satellite system is required. So unlike some other vendors offering a dedicated library, it is where to run the full process, you need to actually buy additional modules for workflow, for modules for data storage. It's all in one box and does not require any satellite systems. So that's, I think, all I can fit into the time I was given, but happy to take any question right now throughout the session or after the session through our Nigerian colleagues. Thank you.
Okay, thanks very much, Mark. So over to you, Christian. Christian will talk to us about the managed services over the next few minutes. Christian.
Sure, thanks, Bulwan. Just want to see if I can control the slides. There we go. Okay, so as Ark described, one option, you've got a few options when it comes to your IFRS 17 calculation engine, or as it's sometimes also called your overlay model, and the reason it's called an overlay model is you will still have your current accounting systems, you will still have your actuarial models, but you need a system that takes all that information coming from those systems to do the IFRS 17 specific aspects that's new. And as I mentioned before, quite complex. So when it comes to the overlay model, you have a few options. Many companies that implemented or that started the implementation projects quite early 3-4 years ago, at that stage, the vendor solutions was particularly immature in terms of how progressed they are. Many of our clients then decided that they do not want to wait for the vendor solutions to come up to speed, and they decided we're going to build the overlay model ourselves. So that's one option. The other option, clearly, that I already just alluded to, is that, and the situation has changed drastically over the last 3 years. There are many vendor options to potentially choose from, and you can go to a SAS, a SAP, Moody's, Oracle, and you can go and buy a solution from them and get them to come and implement it. Now, clearly, as PwC, we've built IFRS 17 in a box, and I guess that's then another option that is open to clients. And clearly, we are biased in this, but we think that's a fantastic option for clients if you want to go down the route of buying a vendor solution. Then, I guess, as a third option, and something that we've launched fairly recently as PwC, is to say, if you don't want to buy your vendor solution, or if you're not going to build your own solution, why don't you let someone with a lot of experience and access to the right tools, why don't you let them take this whole aspect of IFRS 17 off your hands to a certain extent? Now, that needs to be said in the context that financial statements of a company will always remain their responsibility. But given the experience that we've built and the access to the tools, what the managed service comes down to in very simple terms, and I'll go into a little bit more detail, is if a company gives us the right data, we can do the whole overlay model part of the calculation and pass back to... Sorry, there's some feedback on the line. So, Victoria, maybe from your side? There we go. Thank you. So if you give us the data, we'll do the overlay model calculation, and we'll pass back to you debits and credits, all your disclosures, audit trails, etc. We'll go through that in a little bit more detail in some of the coming slides. So that describes the service. We've spoken about the solution. A key part of this is the support that you're given. We appreciate that people have their current day jobs, It's a difficult economic environment, so there's not a lot of money just floating around the system to spend on projects like this. So to get extra resources and to train them up, let them get the experience, may be onerous for many companies, and therefore the support is I guess the key differentiator of this service. So you'll have access to people with the experience. If you don't understand the results, they'll calculate the results for you, they'll help you understand the results, etc. And then ultimately, as I mentioned, it will save you a lot of time and cost. So just very briefly, we've spoken through the features of the solution. Fully pre-configured and operational, allows for all the explicit and implicit options in the standard. So all you need to do as a company is you need to understand what the data model looks like. The data model just being, this is all the data that you need, and we will help you understand all the data that you need. That data will have to be sourced. You need to understand what the decisions are that needs to be made, but instead of having to go and read through the standard and trawl through it and kind of, as Ark said, you read the standard, then you need to translate the standard. That's already done. We can tell you need to make these 50 decisions, help you make those decisions. If you have the data and you've made the decisions, you can run, you can upload the data through a secure web portal. The calculations will be performed and passed back to you. Another feature is that for any changes in the standard, clearly the model will be updated. You don't have to worry about any maintenance or any updates that will be made to it. And then within all of this, it will be done in a very controlled environment. So we've gone through all the necessary requirements about data security, and then we've also built in lots of controls and checks on data, etc. So all of that is taken care of. So what do you actually get? So you get all journal entries, so all the debits and credits. There's a granular chart of accounts that you have access to. It's pre-configured in the according to the PwC illustratives, but it's also possible to change that to satisfy your own needs. That then translates the journal entries into your IFRS 17 income statement and balance sheet items. The disclosures, it was spoken about before, but if you've not looked at the standard, the disclosures are actually immense, and a lot of the complication of IFRS 17 is actually just due to the very detailed nature of many of the disclosures, which unfortunately, if you want to be aligned with the standard, you have to do. And then also very importantly, a question that comes up quite often is how will we know this is right, and how will we actually convince our auditors that this is right and that this isn't a black box. So we'll also give you a very, very detailed audit trail for every liability component. You'll go all the way from opening, accretion, unlocking, every single thing on a group level that happens to every liability component in every group, all the way from opening to closing, will be given. So you will all be familiar with an analysis of surplus, which serves as the main check on many actuarial and accounting calculations, and that check's given. And then on top of it, it's back to the support model, so we can also assist you to get the auditors over the line. And of course, you will get the full documentation of the solution. So documentation, audit trail, and to the extent that the auditors are still not happy and have further questions that you're unable to answer, that's something that the Centre of Excellence can help you with. So I'm not going to spend a lot of time on this. I've mainly covered it, but just how it will work is you'll run your actuarial cash flow models and accounting ledgers, upload the data to a secure platform. Solution will take in the data, perform some of the checks and calculate the results. The results are tested automatically with some internal checks. we'll review the results for reasonableness before we pass them back to you, and then you can download your results once the service is completed. All the items that I've mentioned before. The last slide, just very briefly, how will it work? So you decide, okay, this is a good option. We come to an agreement and we start. How will it actually practically work? So first step will be that we'll understand where you are in terms of your IFRS 17 readiness. And that will then determine what the activities are that's needed, the time and effort to implement this. We will onboard you through our platform. We will give you access to the documentation so we can start going through those decisions that I alluded to. We'll make sure that you understand all the data that's required according to the data model. And then once you're there, you can get access to upload data, and we can start doing dry runs, understand the results. Once we're through that, once we've done that, we can start thinking about your transition calculations. And then ultimately, once all of those steps are done, we can move into a business as usual phase and calculate results, potentially automate the whole process of data sourcing, etc. Yeah, so that is our managed service in a nutshell. Appreciate that I've ran through that fairly quickly, but happy to take any questions on it in the chat or otherwise.
Okay. Thanks very much. Okay.
Yeah. Thank you, Christian. Thank you, Rowan. Thank you. Hopefully, the implementation challenges that we've gone through, as well as some of the solutions that we can provide as PwC, has helped people give an idea of how to deal with some of the questions and the queries around the implementation of IFRS 17. Thank you very much. Please, a reminder that we're still taking your questions. We have a few questions that come through. We've responded to some, and we will respond to more of them in the Q&A session. Please use the chat box or the Q&A function. I'm now pleased to sort of hand over to the chairperson of the technical committee of the NIA, our dear Unjum Onyemenam, who's also, who's also in her own right a CFO as well of NSIA Insurance as well, on the industry's perspective, and one next. Unjum, please, over to you to sort of hear from you. Thank you so much.
Thank you, PwC, and thank you for organizing this insightful session. Thank you, Omobolanle, for giving us this opportunity to also respond to all that we have listened to today. I believe that everybody here, my colleagues in the insurance industry, are really excited to listen to this wonderful presentation. Yes, my first, okay, let me also say good afternoon to my colleagues who are here, and I also want to say thank you to the Director of the Director of Inspectorate of National Insurance Commission, who is joining us in this session. It's actually good to all be here and learn from the same source. IFRS 17 has been has been a source of concern for many of us in the industry, especially those of us in the financial reporting chain, the actuaries and all. There's always one new thing or the other. Since 2012 or prior IFRS, just before we adopted IFRS 12 and IFRS itself in year 2012, it's all been one thing or the other about international reporting, financial reporting standards that insurers have to actually adjust themselves to. So each time we keep thinking, oh, there's something new coming up, there's something new coming up. We ponder over so many things in our minds. We are wondering, how do we start these new developments? IFRS 17 is here again. We had actually thought that we had adopted the IFRSs, and each time there's something new, there's a new development coming up in the standards. And operators are wondering, how do I ever get to read up all these things? How do I ever get to know all the details? How do I ever get to execute? And then parallel to running the business every day, it's a huge concern for us. So we keep thinking as operators, now IFRS 17 is here, where do I start from? How do I initiate this project? Because it's a project of its own, a full-blown project, and it's like setting up an entire project. And then you wonder, where do I start this journey from? These are all concerns that we ponder over as operators. And then you keep hearing, oh, IFRS 17 has its own components. What are those key components? How do I get to know them? How do I get to implement them? And then you also keep hearing that there are impacts here and there. You need to start now. You need to start now. No other time than now. And these are all concerns that we keep pondering over. But it's good to be in this session and know that at the end of the day, there is a solution. I'll go into the details I'll run through the details of what each of those concerns could be. Next, please. And so our first thoughts are, what comes to mind? Oh, something new has come. They tell us that we have to measure our insurance contract. We've not been able to measure the insurance contract liabilities after IFRS 9 went after the effective date of IFRS 9. We're all waiting to be able to know how to measure our insurance contract. And then the industry hears this, and then we kick off with initial awareness campaigns. We initiate a project as an industry, as NIA. NICOM comes, joins us, and then we hear that we need to get all stakeholders aware of what is going on. We call in our actuaries, we call in to come and enlighten us. We have our own forums where we begin to train ourselves, teach ourselves what we need to know. We engage the audit firms to also help us see through this, see through the learning process. We ponder over what is going to be the key activities and objectives for this IFRS 17. How am I able to identify what the objectives are? We've heard all those things here. And we keep asking ourselves so many questions. We're asking ourselves, NICOM also now comes and deploys a roadmap for us, and then we remember again, oh, IFRS 17 roadmap, we've done other roadmaps for IFRS adoption, we've done IFRS 9 adoption roadmaps, and now NICOM comes again, the regulator wants to coordinate each and every one of us to make sure that we are all following seamlessly through the process of transiting from IFRS 4 to IFRS 17. These are huge concerns for anyone in the financial reporting line and also for the insurance companies as a whole. We ask ourselves, when do I get started? And suddenly you hear that you have to even get started right ahead of the time. We've also been told here the timeline, so I don't want to repeat that. And then you keep hearing about the components of this, of what IFRS 17 involves. There are measurement models, which Uloma had initially also reviewed those models with us. Next, please. And we keep going on and on, hearing one new thing or the other. And then what will this model entail? What are the objectives of this model? You hear that there are impacts here and there are business impacts. You hear that there are financial impacts here and there. You hear that you need to understand your data. You need to transmit your data. You need systems. You need the processes to change. You need policies. You need to do gap analysis between what was existing, what the standard was provided initially and under IFRS 4, and what the standard now and what the standard is now providing under IFRS 17. What are the gap analyses? How do I marry these things? How do I actually truly say I am prepared? How do I design my system, my chart of accounts? How do we really implement? And even after implementation, how do I continue after implementation? And all these questions go on and on. You go into the details of those impacts. But it's interesting to hear this afternoon that there is a solution, many solutions, maybe, but here we we're also very pleased to hear that we have the award-winning solution being introduced to us by PwC. It's very interesting to know that PwC team has, well, we're all concerned about having all these worries, going through the concerns, wondering how to run our roadmap, how to actually implement this project. Today, I'm very happy to know that I don't have to bother myself so much anymore. That PwC has a solution that can solve all these concerns. You can actually, as an operator, go for PwC's managed solution. You can actually go for the IFRS 17 box solution, depending on what your preferences are and the cost implication, I would think, even though they haven't told us about the cost implication here. But it now depends on you. The choices are open to you. It's open to us as operators to either do it myself. I can choose to do it myself. But in reality, do I actually have the resources? The time, resources, the efficiency, and everything? Do I have all that? We see that PwC over time has actually been going through this process, trying to develop this package, a solution that can serve everyone. And I actually want to commend this effort. It's a big one, and it's good that it's been introduced to us, and we are aware that aside from the fact that we have to read, you cannot throw away the fact that you need to read and update yourself with the knowledge. We can't also throw away the fact that we need to go through the trainings, at least even know what it is all about, so that even when you are applying the solution, you know you understand the solution better, you know what the solution is offering you, you know how to raise the questions around the solution, you know what you are implementing at the end of the day. You're not just taking something off the shelf and it's okay. Your auditors now ask you, how did you arrive at this? And you don't even have an answer to explain, to justify the package. I know that the place of learning can't be overemphasized. It's important to still read, but now someone has is proffering us a solution which is quite interesting, and it takes away all these concerns from at least the CFO or whoever the head of finance could be in that reporting function. It takes away all these issues, but I actually think this is a very welcoming idea, and every stakeholder in the insurance industry, it will be good to know that this is available, and then begin to also bring to the attention of our board the requirements of IFRS 17. Those are the next things we need to do. We actually need to make sure that we are prompt in action. There is no time to waste. The earlier you start, the better. Get started. It's a lot to do. That's why the fact that you have a solution, you still need to get started so that there are no surprises at the end of the day. Tweaking the solutions to your own situation, to your organization situation, prompting the various stakeholders in your organization, especially the key decision makers, whether to go for to buy the solution. And now we also have other issues that running concurrently for us in the industry. We have the major issue that concerns recapitalization. And so when we're talking about recapitalization, I don't think anybody wants to be a major distraction in the recapitalization process. To ensure that we keep the page, or we keep to the right page as we ought to. I actually want to just say thank you, PwC, for this session. Operators are really very happy to have this package. And I guess the sky is our limit with this. Our concerns are put at bay for anyone who wants to go for this option. So thank you, PwC, and thank you, everyone, for this time out here. Thanks.
Thank you so much, Njim. Thank you. Very much appreciated. Great. So we now have the question and answer session, and the session sort of going through some of the survey results. So one of the things that we did was to do a survey across the industry to see our preparedness. And we would like Ruwan to please take us through some of the survey results. And we'll also go, so Ruwan, once you're done, we'll just go straight and answer the questions that have come through so far. Thank you very much, Ruwan. Over to you.
Okay, thanks very much, Bolanle. So like Bolanle mentioned, we use survey across the industry, and the survey cuts across IFRS 17 implementation around the people requirement, the systems and data requirement, implementation challenges for people that are already implementing IFRS 17, and also around the cost and budget of for IFRS 17 implementation. Now, 69% of our respondents are from general insurance companies, 25% from compulsory, just about 6% are from life insurance companies. Now, the first question we asked was around awareness and training. And of the respondents, only 12% said they've been training across the entire organization. Just about 44% said they have been training to the key staff. Key staff here meaning the IFRS 17 project team. And about 45% of those respondents said there has been no training whatsoever on IFRS 17 in their organization. On how well people understand IFRS 17. 69% said they have limited knowledge on IFRS 17. About 20% of our respondents said they had no idea what IFRS 17 is all about. And about 13% said they had intermediate knowledge on IFRS 17. Hopefully with this seminar, those numbers would have improved significantly. And we also asked about about the understanding of the board of directors of IFRS 17 and how to change the dynamics going forward. Well, 50% said the board has limited knowledge and they don't understand how IFRS 17 is going to change the business. About 19% they said they have no idea, and we have about 25% respondents said that their board have intermediate knowledge of what IFRS 17 is about. Now, we also ask about the approach to building capacity locally, in insurance, amongst insurers in Nigeria, and a combination of factors that people provided. About 50% said that they're building capacity in-house, basically trying to reach the standard and understanding what it presents. And then another 50% also related to the fact that they're trying to learn as we go on in the implementation process. The biggest cohort is in the external training, which is about 56% of respondents said they're relying on external training to build capacity, and 25% of respondents said they have no view yet on how they intend to build that capacity. So on the solutions, on the solution strategy. That's in whether you on how they intend to approach IFRS 17 implementation, considering everything that we spoke about and how impracticable it might be to do it manually. About 12% of our respondents indicated that they intend to build an in-house solution. 66% said they would build an in-house solution with a wider focus on enhancing data. Then about 25% said there would be a sort of partial finance transformation, while 57% of the respondents do not have a clear view yet on how they are going to approach the systems for IFRS 17. On vendor selection, about 12.5% of our respondents have selected their vendors. 44% are at the level where they're having high-level discussions, so they're still surveying different vendors. About 38% have no activity in that space yet, while 6.3% have gone into advanced discussions with specific vendors on IFRS 17 implementation. On the expected time to duration, the amount of time that it would take to complete IFRS 17 implementation, 38% of our respondents said they are unsure how long an IFRS 17 implementation would take. About 13% think it would take between 0 to 12 months. Or 43% think it would take more than 12 months, but about 2 years, while about 6% think it might take up to 4 years to fully implement IFRS 17. That gives us an insight into how, into the distribution of the perception of how complex IFRS 17 implementation would be. On whether we would be ready in 2023 when IFRS 17 implementation, IFRS 17 becomes effective, 56% of our respondents are confident that they will be ready in 2023. 13% are uncertain whether they will be ready or not, while 31% are somewhat confident that they would materially comply with IFRS 17 come 2023. On the impact of productivity of insurance companies, 50% of our respondents say they do not have an idea how IFRS 17 is going to affect the productivity, the profitability of insurance companies. 38% think with the implementation of IFRS 17, there would be lower profits. 6% think there will be higher profits. About 6% think there will be little to no impact of on profitability of IFRS 17. Keeping in mind that the distribution of our respondents is significantly skewed towards general insurers and composite insurers, the statistics is really interesting. Then on the challenging areas for IFRS 17 implementation, in terms of what people have seen to be the challenging areas for implementation of IFRS 17, bulk of our respondents, 69%, think the most challenging area is in provision of data, which is consistent with what Christian had mentioned earlier on. 62% think is in the putting together the accounting policies, considering the enormous number of options and methodologies that are available in IFRS 17. 56% of our respondents think it's between setting the actual methodologies, the time constraints that we currently face, as well as sourcing the right skill and talent to support with IFRS 17 implementation. While 50% of our respondents think the technological constraints as well as the budgeting constraints will be the major challenging areas for IFRS 17 implementation. On the cost-benefit analysis of IFRS 17, 38% of our respondents are indifferent. They do not know, they are indifferent about whether IFRS 17's cost measures up to the benefits. 37% agree that the benefit of IFRS 17 would outweigh the cost. 6%, just 6% think that the benefit of IFRS 17 are not more than the cost, and 31% have no idea on that. And on the current budget that insurance companies have, about 44% of our respondents think it will cost between 25 million and 100 million to fully implement IFRS 17, while 56% of our respondents think their own budget for IFRS 17 will be less than 25 million. That's high level what the responses that we got from the industry on the status of IFRS 17 implementation projects are, and on the state of where insurance companies are currently in their implementation project. About 31% of the industry have not started at all the IFRS 17 program. 31% have only had in-house training, meaning about 62% of the industry have only had trainings on IFRS 17, and 31% of the industry have done gap analysis and sort of they've done between gap analysis, ranging between gap analysis and financial impact assessment about 31%, and just 6% of the entire industry has gone on to the design phase where they are now trying to design their systems and their processes and their target operating model to suit their IFRS 17 programs. So that's sort of the view, the feedback that we got from our survey from the industry on where you are in IFRS 17 and now your perspective of IFRS 17 implementation projects are expected to go. So now we'll move on to the question and answer session. So, if I...
All right. Good afternoon, everyone. We'll quickly move on to the question and answer session. We have a few questions to answer. Just to remind you that you can drop your questions using the Q&A function, or you can raise your hand if you would rather speak and ask your question. Okay, so I will just quickly start. We have a question here. Even though this has been answered in the chat, it will be good for everyone to hear the question that was asked. And I will direct this to Debo. For a non-life insurer who qualifies and has opted to use the premium allocation approach, do they need to worry about the general measurement model? Debo.
Okay, thank you. Yeah, so for general insurance, okay, I was having feedback. All right, for general insurance, I mean, if most of the contracts are within 1 year, you're making a contract, then you don't necessarily need to worry about going with the GMM model. However, if you have contracts, if you're a general business, or you still write some contracts that are actually over 1 year, potentially over 1 year, then you might actually need to start considering the fact that some of them might qualify for the building block approach rather than the minimum allocation approach.
All right, thank you. Thank you, Debo. Our next question here I will direct to Christian. Right. So, Christian, how does the CSM, the contractual service margin, compare to the Solvency II risk margin? Can you help throw more light on that?
Sure. So I guess let's maybe start with the similarities between Solvency II and IFRS 17. So both of them will have a best estimate liability component. Both of them will have a risk adjustment in the one instance, or risk margin in the other instance component. So best estimate liability is clearly just what it says. It's the best estimate, your best estimate view of what the liability needs to be. There are some differences between the two, potentially around contract boundaries that's been alluded to earlier, but for the most, they're going to be very similar. Then you get your risk adjustment or the risk margin, depending on whether you're talking IFRS 17 or Solvency II. And they are there for the same purpose. So their purpose effectively is to say, well, we know that our best estimate is just that, it's a best estimate, but in practice, there are going to be things like COVID as an example. COVID may be an extreme example, but no one, when they projected 18 months ago what mortality rates are going to be, factored in COVID. So we know that there will be deviations around the best estimate. So we need to have a little bit extra in there to account for that risk. And that's really what the risk adjustment and risk margin is there for. Now they're calculated on different bases. In Solvency II, it's more prescribed what you need to do and how you need to calculate it. In IFRS 17, it leaves it fairly open in terms of how you calculate it. So it will give you the principle, but not give you any rules in terms of how it's calculated. So a little bit more freedom, but then saying that you have to disclose what you do, what you've done, and also confidence intervals. So less restrictive, but you have to disclose what you've done. Then CSM is something that's different between IFRS 17 and Solvency II. Solvency II does not have something like a CSM, and effectively what the CSM is what is left between the premiums that you've received, your best estimate liability, and your risk adjustment. The bit that's left is your CSM. So you can see that as almost the profit that's inherent in your policy. And the whole purpose of IFRS 17 is really to say how should that CSM be allocated over the lifetime of the contract. That's it. Hopefully that makes sense.
Thank you, Christian. Thank you, Christian, for answering that question. So our next question will go to Njum. So Njum, we have a question for you. We see that, there are varying levels of preparedness, amongst the insurance companies. We just want to find out from the member companies of NIA, is there some sort of forum or plan for collaboration, a forum where they can, share ideas and learn from each other's experiences?
Thank you, Ifeanyi, for that question. We have a forum where we discuss common issues as insurers, and that's usually in our monthly meetings under the platform of Nigerian Insurance Association Accounting Technical Committee. From time to time, we dwell on practical and technical issues that are immediately affecting us as insurers. Sometimes we also try to engage with the regulator or partner and collaborate with the regulator in instances where the regulator's impacts or the regulator is also a stakeholder or a major stakeholder in that particular issue. Now for IFRS 17, as insurers, we've already started creating some awareness for ourselves. You also can confirm with me that yes, our capacity is limited, our resources are limited as on the operational side, and over time, sometimes we have partnered with organizations like yours, like PwC, to come to help us in enlightenment. And in our sessions, we talk about these things. But with this insightful session that we further had engaged with you, in our subsequent forums, I'm sure we'll be able to engage ourselves more and talk more about how and agree together how we can move together as an industry. There are instances where, as operators, we have done some advocacy. We've collaborated sometimes on issues that have to do with us as an industry. On IFRS 17 for now, we don't have any collaboration scheme ongoing, but I believe that as we enter into the next year, we'll accelerate what we are doing with IFRS 17 collectively as an industry, because now our understanding is better. This session has given us an opportunity to know more, to gain added knowledge and information that we can use to drive our sessions. So those forums happen every month, but the details of what we discuss is determined by what is actually more pressing at the moment. So I would say that for now, IFRS 17 is also one of the pressing things, and come 2021, we'll elaborate more and explore the various opportunities that we have as an industry to do better. So I don't know, maybe I should also ask a question as an operator. Is it, this solution that PwC is offering us today, is it a solution that the industry also can collaborate? Maybe companies can collaborate to have it or something. I don't know what PwC has in stock for. If there are collaboration opportunities for insurers to come together to, or is it per company that a product is going to be deployed and all that?
So I can just quickly take that on June. There is an opportunity. So when we look at the managed services, if we do get enough insurance companies interested, it is something that we can come together. So we can take that offline and discuss this further. There is the managed services, and there is also another solution that's also that we can also look at to see how that can plug into what's being done. That can help insurance companies. So we can take it offline and discuss well.
Okay, thank you, Bolanle, for the response. It's good to just know that it's something to be explored. Thank you.
Okay, I can see there's a question. Continental Re, he's got his hands up. Evan, can you please unmute him? He wants to ask a question.
Thank you. Tried to raise my hand. I was actually wondering if you can see it on that side. But my name is Tato Holof, and I'm the actuarial and risk manager at Continental Re, but also the lead project lead for IFRS 17. I have 3 questions here. I wonder if I'm allowed to ask more than one.
Yes, please go ahead. We'll try and answer them as quickly as possible.
Yes, the first one is about the groupings. What are the implications of the groupings? Because we have 3 groupings there: cohort, profitability, and underwriting. So for us reinsurers, we have an additional layer, which is treaty sec, non-prop versus proportional. So what are the implications now on the groupings when it comes to reinsurers, as well as what are you seeing in the market? Because as reinsurers, we also have very limited data. For example, the treaties, the only data you get is a bordereau, and it doesn't contain information on the risks. Even the classes sometimes are combined. You find a fire, maybe another class under the same treaty, and the premiums would be and claims would be combined in the same bordereau. So we don't have that granular data at the reinsurer level. The second question would be, what are you seeing in terms of, as PwC, what are you seeing in terms of implementation across the continent, especially for your smaller guys? Because our experience is that we've met a lot of vendors, and we actually realized that the pricing is a bit on the higher side. So we are wondering about the smaller guys, the smaller insurers or reinsurers who are using currently maybe spreadsheets for that reporting. Are you seeing them actually getting these solutions, or I would just like to get to know what you see happening on the ground regarding that implementation. Then the last one would be about your solution, IFRS 17 in a box. How flexible is it? What if I have maybe currently a solution up to my IFRS 17 calculations engine? Is it able to now adapt those and just finish the whole process? Or you'd like where you start from the beginning, you do all the calculations and you just give us the results? Is it a very flexible solution that can fit to the client's needs? Those are my 3 questions.
All right, thank you, Tato. To answer your question, can you please address his first question?
Okay, sorry. The first question was on profitability. All right. Depending on the
groupings and profitability.
Yes. So the first question was on grouping and profitability. From our perspective, I think that depending on how you've currently done your groupings, so when we do the course of presentation, we talked about the fact that some of your contracts will be profitable, some will not be profitable. And one of the things you see currently is that there will be some offsetting across your portfolios. All right. So, to the extent that you separate portfolios, it means that you can actually begin to see which is profitable, which is not profitable. And some of those offsetting benefits that you have previously, you might not actually see them going forward. I think that's one of the key things that you might actually see from area of profitability. However, it also depends on how you've priced your product in the past and how what your loss ratios and whatever your profit metrics currently look like. So if if currently you most of the products or most of the lines that you have, even within those levels of the groupings that you have, are currently profitable, but I don't see how that shouldn't significantly impact on profitability for you, and how you measure it. But if what you currently have is a situation where you do a lot of offsetting, which is what is basically prevalent in the market, I think that would then, there will be some interest on that. The other question you asked was around implementation. Okay. For implementation, I mean, we have solutions. So our solutions would be scaled down. I mean, there are a lot of conversations we're having in terms of how we want to support a lot of smaller e-commerce companies in Nigeria. So some of our solutions would fit for them, and we're also very open to consider the peculiarities of the market and the size of the finance companies in Nigeria. I mean, determining the price points on our products. But I mean, these are conversations that we've had with some people in this call who are already talking to us on some of these solutions. So we are considering that the market actually has more players. And we are also considering solutions. I mean, these solutions, we price to be able to work for them. We also have the solutions, some other solutions that we're looking at, and also some other things we can also do to help them, especially the managed services, in case they're not able to afford the IAB and any other systems that might be introduced.
Okay, thank you for that, Table. Tato, for what we're seeing, the truth about it is that we are seeing a variety of things. So there are some entities, the smaller ones, that are using Excel. There are some, as I said, that end up going for our managed service. And there are some, you will find that a lot of smaller players have not really started and probably do not know the cost implication yet, or they're waiting to see how, what others are going to do, and then maybe see if they can tag on to certain opportunities. So that's what we are currently seeing as well. Ulama just sort of, so one of the things that, one of the other things that as a reinsurance company, we'll come back to you on that shortly. I just wanted to say on the IAB as well, because I'm just conscious of time. IAB is flexible. So if you already calculated your cash flows and you've gotten to that point, it is flexible to be able to sort of take on the calculations and then come up with your IFRS 17 numbers going forward. So it does allow you that flexibility as well. So that's something that you don't have to worry about. You can also do that. For reinsurance, I don't know if Rilwan or Christian want to add more on the facultative and treaty and how it affects grouping. So if any of you want to add to that for Tato's sake. Rilwan or Christian, anybody want to add more to it, or Debo has covered it? Okay. Rilwan?
Yeah, hello.
Sorry,
yeah.
Can you hear me? Sorry, I wasn't sure if anybody could hear me.
Yeah, I can hear you. I was hoping because Christian has done a lot more reinsurance. I was hoping maybe it was still there. Okay. In terms of for reinsurers, you mentioned that in terms of the data, I mean I think the fundamental thing is about the requirements and meeting those basic requirements of the standard as to what should form a unit of account. When you're doing your grouping, and the criteria that the standard sets out what should really guide what your decisions are in terms of the annual cohort and also in terms of the profitability, like Debo already mentioned. Now, if those end up not having sufficient, if they don't end up having a lot of data, it still doesn't take away the fact that they are still within a group. So we cannot say because they do, we cannot violate one of the principles of the standard because we don't have sufficient data. So if you have a group, say in probably one of the groups that you mentioned, and all you had in there are maybe 5-10 contracts, then that forms the group, because the standard is clear as to what can be included in the group. You cannot then say because probably this group is small, then you have contracts that are more than the specified number of years apart. That cannot happen. You cannot have contracts that are profitable or onerous. You can't have them in there. So one of the things that we've seen for insurers in Nigeria is they still go ahead with the NICOM grouping in terms of determining what constitutes a portfolio of accounts. And that's not necessarily cast in stone, because what the standard requires is that insofar as they're managed together. So I think if you want to do this, you need to start from the level of what do you manage together, and that is a question that only you can ask. So for your reinsurance contracts, how do you manage them internally? And as soon as you reach a decision on what is your portfolio of contracts, then drilling down into what the unit of account is or what each of those cohorts should be, then just needs to follow through on what the requirement of the standard is, which is very clear, and the principles cannot be violated. So where you can apply a bit of subjectivity or judgment is in terms of how do you manage those risks. As soon as you get off that level, then it becomes a bit strict in terms of how you should assign those contracts into specific units of account, irrespective of whether you have a lot of contracts in that unit of account or not. I don't know if that answers your question.
All right, thank you, everyone. Thank you, everyone. This concludes the Q&A session. So I'll just hand it back to Bolanle.
Thank you, everyone. Thank you, Ifeanyi. Thank you, everyone. I just wanted to say thank you to all our attendees and our panelists, and our wonderful distinguished guest, Mr. Barry Thompson of our NIA, the Director Inspectorate, as well as the Director of Technical, Unjum, who is also in the industry as an insurer with NSIA Insurance. We just want to thank you all for your time, for being part of these events, and I hope that you've taken a lot out of it, things to help you prepare, things to know that's available. The truth about it is that we cannot overemphasize the fact that we need to start now. For those who haven't started, wherever you are in your journey, we want you to start, because a lot of times we underestimate how long it takes to implement. Earlier on we said the fact that because of the fact that there are a lot of decisions that you have to make, a lot of groupings that you have to do, the fact that there's a lot of data that you need to be able to have to be able to implement it appropriately. And of course, the fact that when you implement a new standard, especially something as significant as IFRS 17, it's not just about the accounting, it's not just about the actuarial. It also affects your business, it affects your IT systems, it affects your processes, it affects the way you run and issue your products as well. There are long-reaching impacts on it, and it's important. The starting early helps you to make any adjustments that are required, and also helps you to start, stop, try again in some cases if you are trying to sort of deal with certain judgmental areas. As I said, we've recorded this session, so we will also make it available for you to have a listen through. I know there's a lot of information that has been gone through, and hopefully it has been quite educative. Of course, we are always available. Once we will also send out an information about our contact details if you want to reach out to us, and when you require, if it requires support or additional clarification about various areas, we are of course available to support and help you. We wish you a wonderful rest of the day and a wonderful rest of the week. Thank you once again, and we hope when we call on you to attend any of our sessions that you'll be willing to do that again. Thanks again, and have a great day. Thank you.
Thank you.
Thank you. Thank you very much. Take care.